Welcome back to Wealthy Business, the channel where we decode finance, technology, and the global economy. Today, we examine a radical proposal that could rewrite how Wall Street and the global financial system operate, ending quarterly earnings reports for U.S. public companies. President Donald Trump has once again floated the idea of switching from quarterly to semi-annual reporting, saying it would save money and help corporate leaders focus on long-term value creation rather than the next 90-day earnings call. This might sound technical, but make no mistake. It touches the very heartbeat of capitalism: information. Who gets it, how often, and how markets react. Warren, Trump's proposal, the end of the 90-day clock on Truth Social. Trump argued that companies are too focused on quarterly profits and should be allowed to report only twice a year. Did you ever hear the statement that China has a 50 to 100-year view on management of a company, whereas we run our companies on a quarterly basis? Not good. This is not the first time he's pushed the idea. During his first term, Trump asked the SEC to study reducing reporting frequency, but no concrete action followed. Now, with a Republican-majority SEC, the idea could have a realistic path forward. Current regulations require public companies to report financial results every quarter. Moving to semi-annual reporting does not require Congress. The SEC can make the change through a majority vote. Experts estimate it could happen within 6 to 12 months if the agency agrees. Why Trump and some CEOs want? This many CEOs complain that quarterly reporting creates short-term pressure. Every 3 months they must show growth, even if it means cutting R&D budgets, delaying hiring, or engaging in accounting gymnastics just to meet Wall Street's expectations. Two of the most respected voices in business, Warren Buffett and JP Morgan CEO Jamie Dimon, have echoed this concern. They argue that quarterly guidance, and sometimes the earnings themselves, cause companies to chase quick wins instead of investing for the next decade. Supporters of Trump's idea say fewer reports would save money on auditing, compliance, and legal reviews, reduce market noise and the obsession with short-term stock moves, encourage companies to think like builders, not sprinters. 3. The case against transparency, trust, and market stability. But critics see big risks. Investors, from large institutions to everyday shareholders, rely on timely updates to assess a company's health. Fewer reports could mean longer periods of uncertainty, creating room for rumors and insider advantages, bigger market shocks when earnings finally arrive, less ability to detect early signs of fraud, mismanagement, or financial stress. Art Hogan of B. Riley Wealth Management put it bluntly, "The pros of quarterly reporting outweigh the cons. Waiting 6 months for official results would cause more difficulties than it adds benefits." In other words, reducing reporting might save corporations some hassle but could cost investors confidence, and confidence is the oxygen of capital markets. 4. How the SEC could make it happen. The Securities and Exchange Commission has the legal power to change reporting frequency without new legislation. With a Republican 3, 1 majority, and 1 open seat, Trump's proposal could gain traction quickly. Still, the SEC is known for independence. Even with political pressure, the agency will weigh the global reputation of U.S. markets for transparency before making changes. 5. Global context. How other markets report Trump points to China as a model of long-term thinking. Yet, ironically, Chinese companies face stricter reporting rules. They must file quarterly, semi-annual, and annual reports. Hong Kong, the UK, and much of the European Union require only semi-annual reports, though companies may choose to issue quarterly updates. However, comparing U.S. markets to Europe is tricky. Europe has fewer mega-cap companies and a different investor culture. As one market strategist put it, how many European companies have trillion-dollar market caps, growing 60% a year? U.S. investors are better served with more frequent data. 6. Potential impact on Wall Street and investors. If this change goes through, Wall Street would not operate the same way. Market volatility. Longer information gaps could mean bigger swings when earnings finally drop. Short sellers and speculators might profit from the uncertainty. Investor strategy. Institutional investors may invest more in alternative data, credit card spending, satellite images, or supply chain tracking to fill the gap. Retail investors might struggle to keep up, widening the information gap between professionals and ordinary people. Corporate behavior. CEOs could focus on innovation, mergers, and long-term investments without the pressure of quarterly calls. But some might use the extra time to hide weak performance. 7. Winners and losers. Winners. Large, stable companies that generate predictable cash flows. CEOs seeking flexibility for R&D and long-term projects. Hedge funds that specialize in alternative data and market timing. Losers, retail investors who depend on regular updates. Startups and growth companies that rely on quarterly buzz to attract attention and capital. Analysts and brokerage firms whose business depends on frequent earnings data. 8. The bigger picture, a shift in market culture. This debate is not just about reporting schedules, it's about the philosophy of capitalism. Should markets reward long-term vision or short-term execution? The US has historically thrived on fast, transparent flows of information. That transparency is one reason global capital floods into American markets. Reducing it could redefine the US advantage. At the same time, an obsession with quarterly numbers has created its own distortions. Entire industries, high-frequency trading, short-term activist investing, exist to exploit those brief windows. Trump's idea challenges that culture. 9. Wealthy business takeaway. Ending quarterly earnings reports would transform US markets. It could free CEOs from short-term thinking and unleash long-term innovation. But it could also reduce transparency, increase volatility, and widen the gap between professional and retail investors. Whether you're an investor, entrepreneur, or executive, this is a reminder: policy changes can reshape markets overnight. Staying informed and diversified has never been more critical.